$300 million. Gone. Not lost in a market crash. Not evaporated in a bad bet. Stolen, one fake document at a time, by a woman the fashion and tech world had celebrated as a visionary founder. Her name is Christine Hunsicker, and what she built wasn't just a company. It was one of the most elaborate financial frauds Silicon Valley has ever seen. To understand how Hunsicker pulled this off, you need to understand what CaaStle actually was or what it was supposed to be. The idea was genuinely clever. Clothing as a service. Instead of buying clothes, consumers would rent them through a subscription. Brands like Ann Taylor and Bloomingdale's would send their unsold inventory to CaaStle's warehouses in Columbus and Phoenix. CaaStle would handle everything the cleaning, the logistics, the shipping, the returns. Retailers paid per customer. It was the Netflix model applied to fashion, and for a while it looked like it was working. By 2021, CaaStle was valued at over $1.4 billion. Hunsicker was profiled in Inc. magazine, TechCrunch, Fast Company. She was the future of fashion. Investors lined up. But behind the polished pitch decks and glowing press coverage, CaaStle was hemorrhaging money. The rental model was brutal cleaning costs, logistics, returns, damage. The business was losing cash faster than it could raise it. And rather than tell investors the truth, Hunsicker made a decision that would define the rest of her life. She started lying. Not small lies, industrial-scale lies. She gave investors falsified income statements, fake, audited financial statements, fictitious bank records, sham corporate documents. In August 2023, she told one investor that CaaStle had generated an operating profit of nearly $24 million in the second quarter. The actual number? Less than $30,000. She showed another investor fake bank account screenshots displaying nearly $200 million in available cash. The real balance? Under $200,000. She forged the signatures of 2 board directors to authorize stock option grants. She fabricated the existence of shareholders who needed liquidity, telling investors their money would buy shares from these people when those people simply did not exist. She pocketed the cash as new capital and told nobody. But here is what makes this case different from most financial frauds. Hunsicker wasn't some shadowy offshore operator. She was celebrated, lauded. She ran a company with real warehouses, real employees, real retail partners. She sat on panels about the future of sustainable fashion. She gave interviews about empowering women in tech. And the entire time, for years, hundreds of sophisticated venture capital investors had no idea that the financial statements she was handing them were fiction. By 2024, the walls were closing in. CaaStle was running out of road. So Hunsicker did what cornered fraudsters often do. She expanded the scheme. She created a new venture called P180. The pitch: P180 would acquire struggling clothing brands, then pay CaaStle to handle their rental operations. It sounded like a logical extension of the business. What it actually was a lifeline. Money raised for P180 would flow back to CaaStle, disguising the desperate cash needs of the original company. She raised millions more, from the same investors she had already been lying to for years. Some of them put in additional money based on P180 projections that Hunsicker had fabricated from scratch. The collapse came the way these things always do. Not all at once, but in pieces. Investors began comparing notes. Numbers that Hunsicker had given different parties didn't match. Auditors who were supposedly engaged by the company couldn't be verified. Documents that appeared official started falling apart under scrutiny. The SEC opened an investigation. Then the DOJ. Federal prosecutors in the Southern District of New York, the same office that took down Bernie Madoff, that prosecuted Sam Bankman-Fried, started building their case. In early 2026, Christine Hunsicker was charged with 1 count of securities fraud. And on March 4, 2026, she walked into federal court in Manhattan and pleaded guilty. The number she agreed to forfeit is staggering. Nearly $300 million, combined across CaaStle and P180, and she faces up to 20 years in federal prison. Sentencing is scheduled for August 5th, 2026. But here is the question that nobody in the mainstream press is asking. CaaStle operated for years. It had board directors. It had investors who wrote checks of tens of millions of dollars. It had accounting firms. How did this go on for so long without anyone catching it? The answer is uncomfortable. Venture capital due diligence is often far weaker than it appears. When a founder is charismatic, when the story is compelling, when the market is hot, investors cut corners. They accept documents at face value. They don't independently verify bank balances. They trust audited financials without confirming the auditor actually exists. CaaStle's investors were not unsophisticated. Many of them were institutional funds. And yet Hunsicker was able to show them a fake screenshot of $200 million in a bank account and they believed it. The fraud worked because people wanted to believe it. The narrative was too good. A female founder disrupting fashion. A unicorn in the making. Nobody wanted to be the skeptic who killed the deal. There is one more layer to this story. In the months before her arrest, as the investigation was clearly closing in, Hunsicker continued raising money, continued sending fraudulent updates to investors, continued making promises about a company she knew was hollow. That is not desperation. That is calculation. Federal prosecutors noted that even as the noose tightened, she did not stop. The question for the sentencing judge on August 5th is not just what Christine Hunsicker did. It is what kind of person keeps doing it when they know the end is coming. That question will determine whether she serves 2 years or 20. Christine Hunsicker built something real. The warehouses existed. The retail partners existed. The employees existed. What didn't exist was the money. And that gap between the story a founder tells and the reality they're hiding is where $300 million disappeared. Sentencing is August 5th. We'll be watching. If you want to know what happens next, subscribe. And tell us in the comments, which financial crime should we expose next?